Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax efficient or tax free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no cost, no obligation consultation with me. Enjoy. Morning, everybody. All right, people are coming in to the meeting. We've all gotten very good at webinars, haven't we? I stopped by the office yesterday, and it's slowly but surely coming along. So hopefully we'll be back in there. I know Jessica's spending some time there this week, but hopefully we'll be back in there soon and be able to see people live. That'll be exciting. But I don't know if we're ever going to completely change away from not doing Zoom meetings or webinars, because they're just so darn efficient, and it's much easier for people and more comfortable for sure. And you can drink coffee while you're doing it. But good seeing everybody. My son is really working hard on getting these videos done for me. So we have probably about, I think I shared with you, probably close to 85 or 90 videos since we started our webinars last year. So he's going through and editing them. And he jokes with me. He said, did you want me to cut out the one portion where you're putting on chapstick or taking a sip of coffee before the webinar? But it's always interesting to have your teenage son helping you, almost 20 now, who is going to break your chops every step of the way, everything you're doing. So here we are, Tuesday, May the 4th. Can't go without saying the joke, may the 4th be with you. But some good things to talk about today. Just like always, we're going to talk a bit about the markets, and then we're going to have a bit of a planning discussion. So let's get started. I want to remind everybody that you are being recorded. You are all on mute. Q&A is available. Click the button, the question button at the bottom of the screen. Chat is disabled. Our registration continues to grow and grow every week, which I'm very thankful for. If you have any topics that you'd like me to discuss, feel free to send me an email. If you want to give me any kind of constructive criticism, I really want to make these webinars enjoyable and informative for you. So if you have any constructive ideas that you want to share with me, please do that. I'm always open to that. And some of you are very good at that, and I appreciate it. And your comments have made these webinars better, I think. We do have some upcoming special webinars coming. I'm having some issues with scheduling. You can imagine it's still a challenging time as a school board director, and hallelujah, I have about 6 months left, 7 months, but no, 6 months. So I'll be happy when that's over, but I'm working through some conflicts there as far as scheduling. So we have funding using annuities and retirement planning and Roth conversions, fiduciary assistance for powers of attorney, trustees and executors, and investment fundamentals. And we will soon be having the videos of some of the guests we've had. Brian Adler, great estate attorney and elder law attorney I work with closely, and Brian's a good educator as well, so that's helpful. Steve Bobrin, when we talk about everything Medicare, that's one of the most popular webinars we have. Of course, Ed Slott, we've had Ed Slott join us, and David McKnight a few times. So we're going to have those available on our website for view, and all you're going to do is put in your email address, and those videos will be available to you. So that's exciting, and I'm looking forward to having all that information. I've got a great team through a company called FMG who updates the website, and I have the person I had before wasn't the best, and now I have a new person who is really wonderful. So you should be seeing some exciting changes on our website as well. Today we're going to talk about, in our planning section, we're going to talk about Roth conversion basics. So it's always good to review these things. Roth conversions, what are Roth conversions? How do they work? It's such a valuable tool in our toolbox to get the tax efficient or tax-free situation in retirement. And it's vitally important. So it's good to know how it works, and these reminders are helpful. I had my Ed Slot training Thursday and Friday of last week. Honestly, I have to go back and listen to the recording. Both days were very, very busy with getting some things done for clients. And I'll tell you a little secret. These financial services firms sometimes are not the easiest to deal with. And my staff and I sometimes really have to spend a lot of time advocating for our clients just to seem like you get simple things done. So a lot of time was spent Thursday and Friday with those things. So unfortunately, I'm going to have to spend some time on recordings with the Ed Slot updates that we had on Thursday and Friday. The good news is I did not need the continuing education credits. I went into my CFP portal, and I'm required to have, I think, 30 education credits over the year, and I have 31 and a half. So I was in good shape there. But anyway, I'll be bringing you some Ed Slot updates from that. The update this week came from Andy Ives in the Ed Slot group, and he talked about his frustration with his parents who are now in their 70s, and the fact that their financial advisor never talked to them about Roth conversions, and he tried to stay out of it with them, but now they're in a place where they really desperately want to get these done. And he was talking about how he wished they would have had the last 10 years to get these done, but now they're coming up with a plan now that they're starting the required minimum distributions, and that happens sometimes. People don't really understand that the government's going to make you take this money, whether you like it or not, because you all know, because you're seasoned and experienced, that if you don't take those required minimum distribution, the IRS penalizes you 50% of what you should have taken. And listen, if you've got a few $1,000,000 in your IRA, that's $150,000 that you have to take that you don't necessarily need or want to take from where it's being pushed out, and you're going to pay tax on that. And you know that all the studies I've done have shown that the average middle class American is going to be somewhere in the 40 to 45% effective tax rate within the next 10 years. And I used to say in the next 10 or 15 years, but that window's closing, as we know, and all the pressures coming from Washington and everything that's going on in the world makes that more challenging. So even our experts in the Ed Slot group have some of the same challenges we have. And you folks are ahead of the game by paying attention to this now. If you haven't already read David McKnight's new book, Tax-Free Income for Life, got a few copies. So I have 5 copies I can send out. I'm sitting here looking at my shelf. I have 5 copies I can send out. So if you want a copy of this, and if you promise me you'll read it, please don't ask me for a book. I'm happy to send you books, but please don't ask me for a book if you're not going to read them. But if you promise me you'll read it, I have 5 copies of the book. Send me an email and I'll be happy to send it to you. Okay, so that is the Ed Slot group. So let's go over some, I'm just checking here. Okay. Let's go over some market information. So I have April end numbers from Invesco. I like Invesco's reports. I've shared them with you before. So they just give me a snapshot every week of what happened the prior week. So this is as of April 30th, which was Friday last week. So that ends the month of April for us, for the market month. So the Dow Jones Industrial Average, the most widely recognized index, was up 2.78% for the month. A lot of volatility throughout the month. Market's down today as well so far. Year to date, that index is up 11.3%. Overall, the stock indexes that we typically follow are all positive for the year, ranging from 13.73% to as a high to a low of, it looks like, 4.79. So really strong market so far this year, even though it's really rocky. So who knows what's going to happen for the rest of the year? A lot of people are a bit pessimistic about what's going to happen for the rest of the year. So now's a really good time to be looking at these portfolios as we're doing now. I have people locking in money into principal protected platforms. A couple of them have these index locks you can do. So it's a really good time to be looking at these portfolios and making changes. The bond market, interest rates actually went down a little bit in April, and we find ourselves having to buy a new car. My wife's car is now 11 years old. Yep, 11 years old, about 100 and 70,000 miles on it, I think. And it's just, I got in it last week to go do something, and all the lights are on. And I said to her, I came in and I said, we have to reschedule your tire rebalance. You have to call the mechanic, and we're getting a new car, because it looks beautiful. It runs great, but I'm a little tired of the uncertainty of it. So we're looking ourselves, which is always fun, as you know. So interest rates are down slightly, so that's helpful. The just about 1/10 of 1%, it's 0.11% over the prior month. So the 10-year Treasury I'm talking about is 1.63, closed on April 30th. The month before that is 1.74. I'm happy to see some stabilization in interest rates. You've heard me talk about rising interest rates, falling bond rates. So I'm happy to see some stabilization there. From MFS this week, there's some really interesting two interesting points. Usually, sometimes there's a lot. In this report, I had two. They were talking about this. This was talking about real estate. The pandemic effect in New York City. Tax officials are projecting a $1 billion reduction in property tax revenue to be collected in 2022 versus 2021. Holy moly, $1 billion, largely due to a drop in market value of its apartments and commercial real estate. So that's in New York. So when we talk about tax increases, often people think about federal tax, but you also have to think about your state tax and your local tax. This is going to put New York in a really bad position. New York was in a bad position anyway, one of the highest tax rates in the nation. It's a really challenging government situation in New York, and a drop in property taxes like that and property tax revenues is going to be very painful. Now, in many areas, including where we live outside of Philadelphia, in the suburbs of Philadelphia, we're seeing the exact opposite. I know two people personally who had no plans to sell their homes right now, but who are selling their homes. So one person in particular, they said, we're going to rent for a little bit and just see how things shake out, but we're surprised at the level of our home value. So we're going to move eventually. We're just going to do it sooner than later. So the median sale prices of existing homes sold in the United States was $329,100 in March. And it's an all-time record, both on a nominal basis, that is adjusted for inflation, and on an inflation-adjusted basis. So things are really skyrocketing, and it's a little concerning for me. I'm glad I'm not in a position where I have to sell my house and move, because the frenzy concerns me a little bit, and it is a frenzy from everything I'm hearing. So BlackRock is talking again about inflation. I'll say that my memory tells me that BlackRock was one of the first analysts to really begin talking about the risk of inflation, and they're hammering it home. And again today, they write, inflation looks set to overshoot the Fed's target. So the Federal Reserve, they're talking about the Fed's target, as we have expected. Yet we see uncertainties around the near-term persistence of the overshoot as the restart leads to unusual supply and demand dynamics. Then it talks about what they've changed in their allocation. So they're basically saying that near-term volatility. They also go on to say near-term volatility and inflation as the economic restart progresses. That's what they see, and believe markets underappreciate potential for medium-term price pressures. So basically what they're saying is, look out. Prices are shooting up. We all know that. We're starting to see it at the pumps, but we're certainly see it in food and building materials out of control. Meats, groceries, it's really going to feel, you're going to feel that inflation very aggressively, I believe. And we're not used to it. We've had very slow inflation over the past couple decades, really, certainly the past decade. So we've really since the early 2000s. So we really had to be concerned about that. And BlackRock is saying that the markets aren't ready for it. They're really, this really isn't baked in. This is BlackRock's opinion. Really isn't baked into market values, and there could be a shock in the market overall when this becomes a reality. And to really kind of add to that, Riverfront gave 3 bullets about President Biden's spending plan. So he's got a $4.7 trillion spending and tax plan They refer to it as ambitious. And but they did read, though large, we believe it will have much less of an economic impact than the COVID-19 relief packages, which were designed to be spent immediately. So it really is uncertain. I read some reports out of Washington whether this huge green initiative is going to really move forward as the president is projecting or asking, because there are several senators who, while the Democrats have control of the House and the Senate, it's a small margin, and these people want nothing more than to be reelected. So there's some of the historic significant increases in spending and tax haven't boded well for the people in office. So nobody wants to lose their position there. Apparently. So there's some question whether the spending package would be that big and the tax plan will be as aggressive as planning. And we talked about that a bit last week when we talked about capital gains. So the question for investors is just how much of Biden's plan has the political support to pass, which we will not know for several months. But listen, I'm optimistic that it's going to be more balanced, but we've been very surprised in the past. So Robert DeLucia writes for Prudential. Now, I've got a lot of information on this, and I have a lot highlighted from his report because I just thought it was excellent this week. And in fact, I went through that report and I did not see anything that said for financial advisor use only or financial professional use only. So if you want a copy of this report from DeLucia at Prudential, send me an email and I'll send it to you. Just make sure you note what you're asking for, the Prudential report. I'm trying to remember what they call it. I closed my email up. It's the Economic Perspectives report. So make sure if you want the copy of this report, ask for Prudential Economic Perspectives. All right. So here are some of the summaries of it. Inflation is, again, speaking about inflation, and he really has some great points in this. Inflation is the critical variable in the outlook for the economy and financial markets. Investment markets thrive in an environment of healthy and sustained economic growth, which can be done only within a framework of price stability. So as we're talking about price stability, so knowing what to expect from prices, this modest or even an average of 2.5% inflation, and we're hitting well above that. But everybody's projecting 3 to 5 to more. So rising trend in inflation will eventually trigger a tightening response from the Federal Reserve. And he goes in to talk about mistakes that the Federal Reserve makes, because really sometimes they can do really great for the economy and sometimes they can bugger it up really badly. So rising trend in inflation will eventually trigger a tightening response from the Federal Reserve. Tighter monetary conditions inevitably lead to either an economic slowdown or a recession. So once the Fed says, wait a minute, we're going to start tightening out the money supply. They're not printing money as much. They're not they start raising interest rates on their end, because remember, the Fed funds rate is still just 0.25%, very, very low, near zero, accompanied by so we're talking about a slowdown or recession, and that's accompanied by a contraction in company earnings. There's a great quote in here, but I can't put my fingers on it. There are two broad categories of Federal Reserve policy mistakes. He's talking about mistakes here. Interest rate suppression, holding its policy rate too low for too long, and creation of excess money and credit. And there's overlap over these things. So it's going to be really interesting to see how the Federal Reserve handles that. Holding rates in artificially low levels results in an overheating economy defined as excessive demand spending relative to supply output. So we have that right now. And DeLucia goes on to talk about the savings rate. We have a lot of people with a lot of funds set aside still. Stimulus checks came in, weren't spent necessarily. People have been saving money over the past year because they're not traveling, they're not getting out, they're not eating. All that's pent up. So we have rates at artificially low levels, high demand, low supply, lots of cash. Boy, that's a problem. So somebody might say, well, I'm willing to pay a little bit more because I happen to have the money there. And then that drives up inflation. And the concern, of course, is when we have much higher inflation and low interest rates. The Fed has a hard time keeping up. And then the entire market's got to adjust. It just has to adjust. And what does that adjustment typically means? Right? Prices fall. All right, let's see what else we have here. I talked about the money supply. So he talks about the money supply currently rising at a 27% annual rate. That's the fastest pace in more than 100 years. That is amazing. So unprecedented growth in bond purchases by the Fed has led to a near doubling of its balance sheet to $7.8 trillion. That simply means the Federal Reserve now owns $7.8 trillion of bonds. So the government issues bonds and they buy them back. That's that quantitative easing you hear about. That is a crazy situation. He writes, my overreaching conclusion is that the unprecedented growth in the quantity of money over the past year will ultimately manifest itself in much higher inflation, although the specific cause and effect relationship may be less precise than in the past. So much higher inflation. Investors should not take comfort from the fact that monetary excesses in response to the 2008 world financial crisis did not accumulate in higher inflation at that time. Major economic, financial, and policy differences between today and 10 years ago, a little more than 10 years ago, mean that direct comparisons are not valid. So it's different this time. It's truly different this time. And the major differences in the extraordinary weaknesses is the extraordinary weaknesses of the banking sector in 2008. Inflation will rise rapidly over the next several years if consumer spending goes into overdrive because of the large pool of savings in household bank accounts. Exactly what I just talked about. Solid recovery in bank loans and private credit would also spark a sustained rate rise in inflation. Inflation will climb to dangerous levels if the Fed opts to raise interest rates rather than sooner, and if the Fed monetizes the federal debt through aggressive purchases of government bonds. That's what I just talked about, where the government issues bonds and the government buys them back. If that continues at the aggressive level that we're continuing, Byelich's concern is that we're going to see much higher levels of inflation. And of course, that's a concern for all of us. He also talks about the concern of inflation on fixed income assets. So fixed income assets are bonds. We've talked about bonds before. And the risk of bonds. It's one of the riskiest areas right now, in my opinion, where we're spending the majority of our time. I can't tell you the number of portfolio managers and analysts I've talked to over the past few weeks about this issue and how to address it in our portfolio. So that is Mr. DeLucia. I gave you some highlights. That is a report worth reading. These aren't things, this is not a reason for you to say, pull your money out of the market. It's something to be aware of. We want you to be aware of the potential risks out there and how do we manage them? Well, you hear me say it all the time. Asset allocation, make sure you've got the right pie chart set up for you with the right components. Those components are important. I see people all the time send me their statements and, they're in a moderate portfolio or conservative, whatever is right for them. But the funds, or it's usually mutual funds in there, and sometimes separately account managed, they just stink. They stink, or they're mediocre, and we don't want mediocre. We don't want stink. And it's not even a single fund family. You can't. Fidelity has some good funds, and they've got some terrible funds. Vanguard has some good funds, and they have some not so good funds, and everybody's the same. So they've got some really good ones, and you have to know how to choose them. And it's nearly impossible for an individual investor. So good asset allocation and everything that is driven everything that drives good asset allocation. Principal protection. I believe you should have a part of your funds in something that is not going to lose money. It can give you some modest gains, but it's not going to lose money if everything crashes. A portion. And of course, it's account segmentation. Account segmentation is when you have a certain amount of money in an allocated portfolio that's based on what your needs are for that time. So you've seen me draw the chart. You've got different segments in your life, and you fund those segments with different allocations. So most people range from very, very conservative allocation, holding a lot of cash, to a very aggressive allocation. It can be 100% stock, and different parts of that along your lifeline. That allows you to have the money that you need when you need it in the short term, but still invest as you need it in the future. Um, it's not it's nothing I made up. It's something I've been studying for many years now. We just put into practice, I guess, at the end of 2019, because it's quite difficult. We wanted to make sure that we had all the calculation, all the tools for calculating it in place, and all the tools for managing it in place. It takes a tremendous amount of time, effort, and focus. So those three things: asset allocation, principal protection, and account segmentation. Certainly things that I don't know who could do that on their own. I can't do it on my own. I have a team of people to help us with this. Okay, so let's talk about, in the time we have left, we're going to shift into planning, and I'm going to just see if I have any questions. And we're going to talk about Roth conversions. All right, no questions. All righty. So I'm just moving some things around here so I can share my whiteboard with you. So just bear with me. Don't you love it when you see somebody's eyes darting all over the place when you're on one of these calls? Okay. All right, I think we're good. All right, I'm going to share my whiteboard with you. I'm going to open this thing back up. All right, here we go. Sharing my screen. Okay, so raise your hand. You should see something in front of you that says 2021 tax planning. Very good. Thank you. We're going to make this a little larger. This is actually the same chart we looked at last week when we were talking about capital gains. But I'm also going to show you, let me drag this down. I'm hoping now you see our website in front of you. Just raise your hand again if you see attleboroughwealthmanagement.com or attleboroughwealth.com in front of you. Thank you. Well, you can access these charts. So if you go to attleboroughwealth.com and you go to this section that says Slot Corner. So this has some information about Ed Slott. It's got a picture of Ed and I. It's got this video, the benefits of working with Ed and Ed Slott Elite IRA Advisor, member of that Ed Slott Elite Advisor group, I should say, and some more videos. But down here, you've got this chart. So you can reference this chart on the website at any time, or you can download it. So if you click download now, it'll ask for your first and last name and email address, and then you can have it in your inbox. But in addition to the tax planning chart, we have the Medicare income planning. This was a real popular one. When I talked about this, I had a lot of people ask me, can you send me that gray Medicare planning chart? And now you can just go on and download it. We also have 2021 retirement plan contribution. So how much can I contribute to a Roth IRA? Well, if you meet the certain income parameters, and we're going to talk about that, you can do, and you're over 50, you can contribute $7,000 a year in a 401k. How about a Roth 401k or a traditional 401k? Well, if you're over 50, you can contribute $26,000 a year. It's got some of these limits discussed in here. Really great information all in one place. It's got these phase out levels. If you make too much money, remember, if you make too much money based on your modified adjusted gross income, you can't contribute any further to a Roth IRA, but you can to a Roth 401k, right? This doesn't matter for Roth 401ks. So that is a mistake people make. And I hear it all the time. Well, I can't contribute to my Roth 401k because I make too much money. Well, that's not the case. This references Roth IRAs. And I, believe it or not, I've had that discussion with CPAs, which shocks me. All right, excuse me. And then we, again, have the tax plan. I don't know why it's twice, but that's okay. Better to have it twice than just once. Information on health savings account and the RMD chart. Now, this has to be changed. I'll have to reach out. This is single life table for inherited IRAs. On the other side of the chart, it is the uniform lifetime table, and that's what you'll get if you download that. So hit those buttons and download that to your convenience, and we'll go back. I'll move this, and we'll go back to the chart. Okay. So with Roth IRAs, we're going to talk about some basics, and just as always, you're going to see me looking down as I'm doing this. So we'll come back to this for a second. Whoops. See that? I used this and I didn't erase our stuff from last week. Oh, goodness. I thought I got it all. There's probably going to be a little bit more. Yeah. All right. I'll try not to spend too much of our time doing this. All right. So Roth conversions. Let's talk about Roth conversions. So here we're talking about Roth conversions, not contributions. We can talk about Roth contributions another day. Roth conversions are a vital tool in our toolbox. With a Roth conversion, we simply have money in your tax deferred account. Remember these buckets: taxable. You've all seen this a million times now. And tax advantage or tax free. So taxable is anything that's going to generate a 1099 at the end of the year. We've got short-term gains, we've got long-term gains, we have dividends, we have interest. So these are your savings accounts, your mutual funds and stocks and things like that that aren't in IRAs or retirement accounts. And then tax deferred, of course, we have 401ks, IRAs, SEP IRAs, 457 plans. Any IRA, with the exception of a inherited IRA. If you have an inherited IRA, you can't convert an inherited IRA, right? Unless you're a spouse. You can just create, there's a way to unravel it if you're a spouse. But any of these others that are in your name, as long as you have money in these accounts, you can convert it. So what is a conversion? We simply, it's like a reclassification. We take a dollar amount, and that's always the big question, right? What's that dollar amount? We take a dollar amount and we convert it from tax deferred traditional IRA to Roth IRA. So when you cross that bridge, what's the toll for crossing that bridge? Well, the toll is tax. You pay the tax as you do the conversion, but once the money's here, so we take, let's say we're going to make this $2 or $2 signs. And once we put it here, no more tax. And the caveat I'm going to give you is the 5-year rule, of course. That means you have to at least maintain a Roth IRA or the Roth IRA, depending on how old you are, for a period of 5 years to be able to draw out any gains within that. So you've heard me say the 5-year rule is very complex under age 59 and a half. It's very, very simple over 59 and a half. If you have any Roth IRA for more than 5 years, any growth that you have is also tax-free. You don't pay tax on. You don't pay tax on, your heirs don't pay tax on. This is a very, very valuable tool. So if you have questions, more questions about the 5-year rule, it's not as complex as you think. People like to make it about complex, but I think it's pretty simple. It can be complex if you're under 59 and a half, but you got lots of time to deal with it. So the question is, how much do you convert in a year? Or what schedule do you do those conversions in? So many people come to me and they'll have somewhere between $1 to $5 million sitting here in this tax deferred bucket. So that can be a big number to convert over time. And we've got to figure out what works, because you've got some hurdles, right? So first of all, you've got time. You're running up against time. And the first time hurdle is the Tax Cuts and Jobs Act, which is set to expire 12/31/2025. Well, if you would have asked me a year, maybe not a year ago, maybe a year and a few months ago, I would have said, we've got a good chance of the tax code staying the way it is until 2025. Now I think it is really, really questionable. So our time is a factor. And then we also have, there's my notes from last week, we also have RMD. With the new RMD is age 72, you have to start taking your money out of your IRA, required minimum distribution. You have to start taking that money out of your IRA. So ideally, we try to get this done before age 72. It doesn't mean that we have to. We have to see if the math works and make sure the math works. So we determine what your schedule is, because you can, let's say you had $3 million in your IRAs. Could you convert that all in this year? The answer is yes, you could. You're going to pay tax on that entire conversion for all in 1 year. So that probably isn't the smartest way to go. So maybe what you do is you develop a schedule, and over time you say, okay, I'm going to do, let's just make it easy, $300,000 a year for 10 years. And you'd have to adjust that for some growth, but that is a possibility. And then you get your money over here, and then you have your funds, your $3 million sitting here, and there are no RMDs and zero tax withdrawals. Well, that's really nice, because if you can take your money out of here in somewhere in the 20s, right? You pay tax. Let's say your effective tax rate is about 20%. And we know that the future tax rates are more like 40 to 45%. Well, that's a pretty good win. It gives you a lot of flexibility. You don't have any RMDs. And if you pass any of this to your heirs, then they also don't pay tax. So they have RMDs, your heirs have RMDs, right? And well, what they have to do now is they have to remove that. Oh, I have to give you an update on that, by the way. They have to remove those funds within 10 years. Within 10 years, they have to take that out because the stretch IRA is dead. So within 10 years, they have to take the funds out of the Roth IRA. Now, Roth 401ks have no RMDs for IRAs. Roth IRAs, but 401ks, Roth 401ks. Let me ask, do Roth 401ks have RMDs? The answer is yes, 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 yes. So that really is a good reason why not to keep your money in a Roth 401k. One of the reasons. So someone's asking a question. Let me just check to see. Dan's asking, shouldn't we attempt to keep them in their current tax bracket? It depends. So it depends. So we're talking about I think by them, Dan, you're talking about the account holders. So we'll call these people Frank and Joanna, because I've got a sample, Frank and Joanna. So it really all depends. Let's go back up to that. Let's address that question in a second. So these are the basics of the Roth conversion and the Roth IRAs. Very, very basic. So conversion, again, is moving money that is today tax deferred and moving all of it or a portion over a schedule. David McKnight calls it piecemeal, over a schedule over a period of time. Many people, it's 5 years, 10 years, 15 years, whatever it is. There's a mathematical equation for it. And that mathematical equation has to be done every single year. So it's not a set it and forget it. So I don't think ever had a situation where we do the same Roth IRA this year or Roth conversion this year as we did last year. Now, remember, this is conversions. We're not talking about contributions today. Contributions is a different thing, and we don't have the time for that. We can talk about it another day. So Dan's question says, shouldn't we keep them in their current tax bracket? Well, let's look at these tax brackets. Now, we know what these are here, right? And so this is currently under 2021. This is married filing jointly. Let's do a different color. Married filing jointly. And this here is single. So let's focus on married filing jointly, but let's keep an eye on single, because there's a couple risks out there. There is risks of just the government increasing taxes, right? We know that has to happen with all the things that we have to pay for. Now a $4.7 trillion spending bill on top of the $9 trillion COVID relief packages and everything else that was not great to begin with when we started that. Well, so that's going to drive taxes up. But also, if you go into retirement married, it's probable that one of you is going to go before the other, right? You're suddenly single. Well, you can see here, look at that. While the brackets, the marginal tax rate brackets may be the same, look how much faster you get into the higher bracket, where look at the 22%. So the 22% range goes from 81,000 to 172,000. Well, if you're single, that's only 40,000 to 86,000. You hit the next bracket at 86,376, and then you top out of that bracket 164,000. Whereas if you're married, you top that out at 329,000. So my goodness gracious, if you're getting older, if you're closing in on your 70s or you're in your 70s, you've got to start having this discussion now, because your time for one of you could be shortening if you're not already single. So to Dan's question, do we want to keep them in their current tax bracket? Well, I would say it depends. So let's talk about keeping someone in their current bracket. So let's just say this is your current bracket, and that goes from 81,000 to 172,000. And this is taxable income. So that's after deductions. There's a calculation you have to do for that. And I'm going to show you what that looks like in a moment. If let's say that your taxable income is $100,000. So what Dan is saying is, why don't we keep them in shouldn't we keep them in their same bracket? So that would mean, well, hey, look at that. Really simply, we could move $72,750. We can take that money and let's go down here. We got $72,750. Well, we can convert $72,750 this year, and we haven't increased their tax bracket. They're still going to pay more in tax money because we're putting more money into that bracket, but we're filling that bracket to the very top. So that's a good strategy. That's a strategy that a lot of people do, and a lot of people talk about. But let's talk about maybe another strategy too. So we certainly want to fill up that 22%, but let's look at the 24%. So the 24% bracket goes from 172,751 to $329,850. So for just 2% more, let's see the difference. 200. So that would give us $229,850. 229,850 minus 72750. That's an additional $157,100. Well, what if we could also take this $157,100 and convert that $157,700 and convert that as well? Wouldn't that be better? Yeah, it would be better from a conversion point of view. You get more money into here. The question is, does it make sense from a tax point of view? And that's why it's different for everybody. It's always different for everybody. Because if you're paying just 2% more, just on this money, by the way, you don't pay 2% on the entire thing. Remember how that works. You pay 10% on, it's progressive, 10% on the first $0 to $19,900. Pay 12% on the next $19,901 to $81,000. You pay 22% on the $81,051 to $172, and you pay 24% on the $172 to the $329. And of course, you pay 32% on the $329,851 to $418. So it all depends. It all depends on that individual, because here your effective tax rate might be 18%. And if you max out and go all the way up to the top of the 24%, well, that might only take your effective tax rate to 20%. And somebody might say, I'm willing to do that. I'm willing to do that because of the risk that we talked about, because the math shows me it's beneficial, and the risks of not doing it are greater than the risks of doing it, and it makes nothing but sense. Somebody might say that doesn't make any sense. I agree with Roth conversions, but I'm only going to do 72,000. I'm going to fill up that 22% bracket. I'm going to be happy with that. I'll tell you that most people I work with are really anxious to get the work done. I have plenty of people that are popping into the 32% bracket. And that's going to be the case with Frank and Joanna Miller, who's a sample client. And I'm going to show you what really makes the difference is the total tax that you pay. So I hope that answers your question, Dan. So shouldn't we attempt to keep them in their current tax bracket? Sometimes. Sometimes it makes sense to push up further. All right. No other questions. All right. So let's look at Frank and Joanna Miller. So I'm going to pull this down. But actually, before I move on, this is something I want you to really think about. Married, filing jointly, and single. Because if you make the same $100,000 here, and you're using Dan's thought about, okay, we want to fill up their tax bracket. Well, first of all, you've already gone through the 22%, haven't you? Yeah, because you're single now. You don't have the benefit of that married. Now you might say, well, I'm going to have less income. Well, not necessarily, because we're talking about IRAs here. So if you have $1 million, $3 million in an IRA in your husband's account, husband passes away, where's that money going? It's going to you, the spouse. The spouse inherits that money. You also have that required minimum distribution. They don't let you off the hook. They don't cut that required minimum distribution in half. Now you've got the same factor you have to use. And if your withdrawal required minimum distribution was $100,000, you alone have to take that $100,000 or you're penalized. Now there are things you can do with it as far as gifting it to charity, qualified charitable distribution, but most people don't want to do that. And if you do, that's fine. We can talk about it. But so we have the same $100,000, but taxed much, much differently, isn't it? So now you'd have to go up to the 24% bracket just to be able to move 64,000. So it's going to take you longer. You're going to have a longer period of time where that tax rate risk is there. So this single versus married filing jointly is very, very important. If you're married, you've got to have this conversation today. You got to find out if this is right for you. Roth conversions can be done until 12/31. We don't want to wait until 12/31. Roth contributions have to be done by the tax filing deadline. That's May 17th this year for the previous year. And then you can do it for this year until the tax filing deadline next year. But Roth conversions have to be done throughout the year and can't be undone. They can no longer be undone. So very important. So pay attention to these tax rates. I know it's a lot of circles and getting messy. But let's look at Frank and Joanna Miller. So for those of you that are new to these webinars, Frank and Joanna Miller was a really fun exercise. I can't remember why I first used them. I think it was just to show our financial planning software. But what I did with Frank and Joanna Miller is I took you all through a financial planning process step by step. And we looked at Frank and Joanna Miller in the beginning, and they were running out of money, and we tried to figure out a way how to make sure that didn't happen. And we did it using principal protection. We did it using Roth conversions, and we tried to do it including life insurance. And life insurance was just not something we could fund for Frank and Joanna Miller. But we ended up, my memory tells me it was something like they were scheduled to run out of money in their 80s. And by the time we were all done working through this, we made sure that they had a surplus at the end of their lifetime. And that's all you can ask for from a financial planning point of view. Boy, it's really exciting as a baseline. We've been able to do amazing things for families, pass lots of money to the next generations, put people in tax-free, zero tax situation in retirement, which is, just such a rewarding and wonderful thing. But primarily, we want to make sure that people aren't going to run out of money. And we work, really hard on that. So right now you should be seeing, this is our tax clarity program. So raise your hand if you're seeing something that says Frank and Joanna Miller, tax clarity. Thank you, Sharon. So this is a side-by-side comparison. This basically does a pro forma sample tax return for the Millers. So you'll see here in 2020, so I put this in last year. In 2020, they were projected to be in the 18, let me go over here. I knew that was going to happen. Son of a gun. Let's pause this here. I got to log back in. I pull all these things up for the webinar, and then sometimes I get logged out as I'm talking. Okay, so we should be back now. So you'll see that what their basic tax return said is that their total tax was going to be about $90,000, their income of $475,000, and they had an effective tax rate of 18.85. So the effective tax rate is just a blended rate and kind of an average of all those different steps I showed you. Some of it taxed at 10, some of it taxed at 12, 22, 24. So they had an effective tax rate of 18.85. Remember, the studies I've done, and my study group has done, has told us that the average middle-class American is going to be in the 40 to 45% effective tax rate within 10 years. So they're currently at 18.85. This is the lowest tax environment that we've ever seen and likely to be the lowest for the rest of our lives. What we're talking about with Roth conversions is an effective tax rate of 21.6. So you can just run, this one's going to be a little grayed out, but you can just run down and see the differences. So IRA distributions and pensions, they had $100,000. So they were talking about already doing some Roth conversions, and we looked at um, in this example, we looked at what if we increased that. So we took it to $200,000. Well, that did a couple things, and this is what's really important. You'll see here that they have on both sides long-term capital gains and short-term capital gains. Well, they're the same here, and they have qualified dividends, taxable total Social Security, and tax-free interest on municipal bonds, state and local taxes, real estate taxes, personal property taxes. So that's their inputs there. Now look at their adjusted gross income. Obviously, their adjusted gross income goes from 440 to 540. Their modified adjusted gross income goes from 468 to 300, excuse me, to 568, 300. That's a big jump. These are big numbers. Net investment income is 51,000. It's 51,000 over here. The tax on that net investment income is the same here. Same deductions and exemptions. These are all they have is their standard deductions. Like many of you, that you don't even itemize anymore. You just have to take your standard deduction. In 2020, it was 24,800. Provisional income. Provisional income is the income that the IRS calculates that or tracks that tells us how much of your Social Security is going to be taxed. Now, you've heard a lot of discussion about provisional income, but it includes many things. It's almost everything that you get, including tax-free interest. Remember, they had tax-free income interest of about 24,000. So tax-free municipal bond interest gets included in provisional income. Any distributions from IRAs, dividends, other interest, and 1/2 of your Social Security. So their provisional income goes from 452 to 552. That means really 85% of their Social Security is taxable. They've got some itemized deductions here. And so then their taxable ordinary income goes from 372,100 to 472,100. Makes sense. The big change for them is instead of just being in the 15% long-term capital gains, well, they shifted some of that to 20% long-term capital gains. Their ordinary income tax went from 81,000 to 114,825. Their FICA, of course, is the same, but their total tax jumps from 89,000 to 124,000. So a conversation that a client has to have, or someone who's doing this themselves has to have, is this additional tax of value to me? Very few people jump to this level, the 500s, but there are definitely people who do, because their assessment is the risk of higher taxes in the future is much greater than the risk of me, or the pain of me paying this tax now. And they might say that difference between 89 and 124 is worth it. And this is important to do, I believe, when you're considering Roth conversions, because you can sit here and talk about percentages, right? We're only going to go from 18.85 to 21.86. That doesn't sound like a lot. You've got to look at the total tax. Capital gains doesn't play into increasing our tax brackets, but it certainly plays into increasing our total tax. And that's something people don't understand either. I've had this conversation with many people about capital gains, Roth conversions. It doesn't increase the tax brackets, therefore it doesn't decrease the amount of conversions you can do, but it does affect your total tax. So it may make it entirely uncomfortable if you've got a big tax capital gains year. So I hope that's helpful. And before I sign off, I'm just going to see if there's any questions on that. Okay. So we talked about Roth conversions today. We talked about the basics of Roth conversions. While they're a very important tool in our planning to get to tax efficient or tax-free retirement, we talked about the market updates. I think it's a really interesting analyst information. We do have some upcoming webinars on Wednesday evenings. We still have to set those dates. And other than that, I think that's all. It's just about 11 o'clock. I will see you all next Tuesday. I appreciate, our registrations are going up every single week, and I really appreciate all of you being on this webinar. Please give me feedback if there's something you want to talk about, or if there's something you want me to part my hair on the others. I'm not going to do that. But or whatever you think will be a better, more educational and more enjoyable webinar for you. Give me some feedback on it. If you love what I'm doing, tell me that too. I appreciate that. Keep an eye out for our videos. I promise they're coming. It's been a long time, but that has been a challenging thing. I think I'm really good at financial planning, investment management, but I learned that video isn't my thing as far as what editing and getting all that done. It's very time consuming, but we've got a good person doing it now. So keep an eye out for those videos. And I don't see any other questions. So folks, enjoy your week and get out and have some fun and reach out to us. If you want to schedule time with me, that calendar is going to populate and you can do that. Otherwise, I'll see you next Tuesday. Take care. Hello again. I hope you enjoyed the video and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.